Hello everybody. Today's episode is with Jake Brukhman from CoinFund, and we talk about Jake's pushback on the FAT protocol thesis and how there are other ways to kind of diversify your crypto assets and to add different diversification dimensions to what you're doing, and not just say, ooh, all these awesome applications are being built on top of Ethereum, therefore I should buy Ethereum. It's a little bit more complicated than that. So we talk about that, and then we also talk about governance and how Jake is currently thinking about governance, and specifically he argues for more crypto entrepreneurs to be thinking about the research that's been done in this space. And one that we talk about that's really interesting around voting choice theory is this thing called Arrow's impossibility theorem, which states, hey, if you believe these two things, the first one's just like, hey, if everybody prefers X over Y, then the group as a whole should prefer X over Y. So if everybody wants Coke over Pepsi, then the group should prefer Coke over Pepsi. You should vote for that. If you want that, and if you want this other one that says, hey, if the preference orders between X and Y remain unchanged, so let's say you have an ordered list of Coke and Pepsi and Sprite, whatever, if everybody, even if you're moving around the Sprite and the Mr. Pibb and whatever, those different kinds of sodas, but your order between Coke and Pepsi remains unchanged, if everybody still has Coke above Pepsi, then the group's ordering should remain unchanged. And so even if you have those two simple things, those two simple requests essentially, or like constraints, the only thing that can solve both of those is a dictatorship. And that has been mathematically proven. So we talk a little bit about that and about voting choice theory in general. One final note before you listen to today's episode with Jake is I just wanted to read a little bit on why some of my patrons support me on Patreon. And one note on that is that it's cool that they are supporting me, because by supporting me, they don't need to support me. They're actively choosing to pay me, even though it's not required. So they're actively saying, I have enough, I'm going to pay Reese. And then I'm also doing that. I have enough, and I allow that to flow back to the system through their crypto pledge stuff. So everybody's saying, I have enough. Let's continue to support each other and allow that money to flow back to the system. And I just wanted to read something from one of my patrons, Charlie, who said he's interested and he's supported because he's been feeling more drawn into the crypto and blockchain sphere, investing a bit, and just curious on what's happening. And so he says, hey, Reese, I value the intense, detailed perspectives you're giving, a lot on interconnected subjects. I specifically value the strong voice you're bringing that focuses on the bigger picture value of blockchain technology, especially when so many people are losing sight of this in the dreams of making money. You're huge, clear, and humble. So thank you so much for that, Charlie. And if anybody else wants to support me on Patreon, you should do so. So with that, enjoy today's episode with Jake. Hello everyone, my name is Reese Lindmark, and you're listening to another episode of Creating a Humanist Blockchain Future. In this podcast, we take a systems thinking approach to creating a better future, so we have a couple different system series that focus on different system scopes. And today we're going to focus on Series C, software systems, where we ask the question, what software systems are built in code? And specifically, we'll be talking about the intersection of venture capital and blockchain and around FAT protocols, a blockchain investment thesis. And to chat about that, I'm very happy to introduce Jake Brukhman to the show. Jake is a co-founder of CoinFund, a blockchain research company and private investment vehicle focused on the blockchain space. Jake, thanks for being on the show and welcome.
Hi, Reese. Thank you for having me.
Yeah, excited to chat. And just as a note here, Jake and I will be ready for this interview because we recorded this before, but I just forgot to click the record button. So, Jake, thank you for coming on again. It was a great interview, the last one, but lost to time.
Let's see if we can recreate it.
Exactly. So first, before talking about kind of the macro kind of thesis side, could you talk a little bit about CoinFund and give us an intro to CoinFund?
Yeah. So very simply, CoinFund is one of the early crypto funds. We've been investing in the space since July of 2015, and we also work as an advisory team to companies of various stages and verticals who are exploring blockchain technology, and in particular building crypto economic business models based on blockchain networks.
Cool. Yeah, exactly. So crypto economic business models based off of blockchain. And I like what you said there, where you used to be able to say, well, we are one of the few of these funds, but now you have to say, well, we're one of the early ones of these funds. Okay, so kind of talking more about on the theoretical side here, and specifically this FAT protocol thesis, could you kind of give us a high-level explanation on what is the FAT protocol thesis and what's kind of your pushback against it?
Well, so in general, the idea of fat protocols is that we can now monetize very low level kind of technological protocols, protocols that live lower in the functionality stack or the network stack of the internet. And if you look back to the early '90s, the author of the Fat Protocol thesis, Joe Monegro, kind of looks back on TCP/IP and makes a note that TCP/IP is now a ubiquitous protocol. It's used everywhere online. It's used in your phone. It's used in all kinds of devices. But the way that people have made money off of this protocol is, in fact, not through the protocol itself, but by building applications on top. So it used to be that the protocol layer was thin, and then the application layer was fat. And the observation that Joel makes is that when you look at blockchain protocols, you have these decentralized networks that have tokens. And it seems that because the tokens are tradable on exchanges and people, buy them and sell them for money, it seems that this creates a monetization model for the protocol itself. Now the thesis, I think, the VAT protocols thesis was really important in kind of educating investors about the correct way of investing in blockchain networks. And basically it showed that when you invest into the private equity of the company that creates a decentralized network, well, that's not necessarily the best exposure to the value that you create. But I think, an article that I wrote recently, which is called "Fat Protocols Are Not an Investment Thesis," talks about how investors sort of took that a little bit too far, and they said, well, now we're only going to invest in some of the lowest levels of the technology stack. And we think that that's going to get us better returns long term, and we think that's going to get us better diversification. I happen to think that it's a much more nuanced sort of situation, and that's what we're here to talk about.
Yeah, that makes sense. So, yeah, the FAT protocol is saying that a lot of value kind of accrues to that protocol, while something like TCP/IP was very thin, so value didn't accrue there. And what you're saying is, yeah, that was a good way to conceptualize it at the beginning, but there are other kind of value ways to where value can kind of accrue within that stack. So I guess one that we want to talk about was maybe Augur as an example here. How might Augur kind of reframe our thinking around this FAT protocol thesis?
Yeah, so I think the first step is to recognize that the concept of a protocol is a very general concept. It's really just a set of standards and communication formats that two computers basically use to communicate in a standard way on a network. Yeah. And you can look at very low-level protocols as doing that, but you can also, in some sense, look at the smart contracts that make up decentralized applications as doing that also, because anyone can come in and use that set of rules to do other things. And so Augur is a great example. On the one hand, Augur is an application which implements a prediction market system where someone can come in, create a prediction market, other people can trade in predictions about the future, and then a third set of people can come in and resolve those markets in a decentralized way and get to an answer when that time comes. But then from another point of view, Augur can be seen also as a protocol, because this is a set of smart contracts that live on Ethereum. Any third party can come in and read their data. It could also build visualizations of that data on top. Or even use those prediction markets in other applications. Mm-hmm. So in a way, Augur is a protocol itself. And so the question becomes, is it better to invest in the digital asset of Augur? Or is it better to invest in the protocol which underpins Augur, which in this case would be Ethereum as represented by Ether? And the answer is, first we have to understand what we mean by better. And I think when people kind of proffer the FAT protocols thesis, they try to say we want to invest lower in the stack because those protocols are going to be more diversified and give us better returns. So we can ask ourselves, is that true of Augur? And what happens is that if you start to analyze like what should be the fundamental valuation of the Augur's rep token, you end up having one kind of model for that, which is based on, originally it was based on the throughput um, on the Augur platform. Then kind of the rules now have changed in 2017, and now it's more based on the open interest in the platform. But in any case, that's a very different model than the relationship that Augur has with Ethereum. And basically, what Ethereum receives is all of the transactions that people participate in as they're using Augur. And so one is a function of, let's say, turnover or value in the Augur system, and the other is a function of Augur's utilization of Ethereum. And those are very, very different functions. And therefore, it seems like it could be the case that to get the bigger upside of Augur, you really need to hold rep tokens.
Yep, that makes sense. And that you can't just look directly at Augur and be like, oh, Augur's built on Ethereum, therefore buy more ETH.
Right.
It can be the case, oh, well, it's a much more textured thing. You got to look at, the turnover and value there versus the utilization of it. And maybe, and it's tough to say, and it might be totally kind of protocol or like application dependent in terms of when you should invest in the lower level and when you should invest in the higher level. So I guess with that pushback as kind of heard here, what would then when you think about that and the new kinds of things that you're investing in, and we talked a little bit about kind of these B2C apps, messaging, monetizing attention, what are your heuristics for investing these days that might not be directly related to a fat protocol thesis?
Yeah, well, I think that if you make that observation that the way that value flows across that stack is actually quite varied, then what I think people want to do is actually create a diversification dimension across that functionality stack. So that means like you want to invest in a few really compelling protocols that you think might become utilized. But you also want to invest somewhere in the middle, and you also want to invest at the top. And I think of the top as things that are close to consumers, like consumer proximate applications, like Kik, like you see a bunch of companies these days from traditional consumer tech coming into the space and building products. And these are the companies that have real user bases that are numbered in tens of millions or even hundreds of millions of users. And I think short to medium term, it's going to be really, really interesting to put, those users in front of blockchain technology and to see if they could get a measure of adoption. And if so, I think the short to medium term really looks much better for those kinds of things, those kinds of consumer proximate applications. Versus these low level protocols. And one very, very interesting app that came out just a week ago is called CryptoKitties.
Yeah, I was going to ask you about that.
Yeah, so we're in this week where crypto Twitter is going nuts over CryptoKitties. And that's because this is a great example of a consumer proximate application with a wonderful user experience that mainstream users can understand. And it's just those kitties are just cute enough that they might push those mainstream users over the edge and get them into MetaMask and get them to be using Ether. And that's really a huge value proposition to me over protocols.
Yeah, that makes sense. So I bet, but let's dive in for a second there. Let me push back on CryptoKitties. I love CryptoKitties, by the way. But let me, and I think it's funny that you're bringing them up because I was going to ask you about them. So CryptoKitties, they're essentially these little kitties that exist on the internet that are connected to a specific, essentially token, a specific like kitty kind of token, and you can then breed them together to create new kitties. And I guess my question would be like, yeah, this is a consumer proximate application, but like, what actual value is CryptoKitties providing? And like, would for you guys at CoinFund, are you looking to invest in these kind of like memes or things like that, or where's the value there?
Yeah, that's a great question, and I think the answer is twofold. So there's obviously like a product value there. CryptoKitties are basically scarce digital collectible items. These are no different than Pogs, Cabbage Patch Kids, Beanie Babies, signed baseball cards and baseballs and things like that. And these are markets that have existed for hundreds of years in our societies, and they're actually quite large markets. The only thing that CryptoKitties does is put those markets into sort of a digital domain, which is not something that we are terribly used to. But the scarcity remains the same as in any of these other markets. Now, on the back end, this is actually a very interesting topic because CryptoKitty is implemented as a transferable but non-fungible digital asset, right? So two CryptoKitties don't necessarily cost the same amount. And so this is just an example, unlike a cryptocurrency, of a digital asset that's non-fungible, and we haven't really seen that many of them. And what's going to be really interesting to see is if this is looked at by regulators, and if they would say, like, look, here's an example of a digital asset that's very clearly just property. It's not a security. It doesn't necessarily make you money on the back of third-party work or something like that. Mm-hmm. So I think CryptoKitties are a great candidate for that kind of guidance.
Yeah, that makes sense. And I super agree with that. There's a lot of time people think about either the utility value of the token versus, is the token a security or whatever, but there's actually this third thing, which is this collectible, scarce, mimetic value, which we haven't really experienced on the internet yet because digital scarcity wasn't much of a thing or it was only centralized, but now we can kind of create decentralized digital scarcity and non-fungible digital scarcity, which empowers things like CryptoKitties. Okay, so thinking about CryptoKitties do you think of CryptoKitties? I agree that CryptoKitties is similar to kind of Kik and Ken or YouNow and Props in terms of its consumer proximate, nature. But I feel like there's a difference in that, like, Kik and Ken and YouNow and Props have like these like complex cryptoeconomic systems that underpin them. Are those the kind of things that you're looking more into investing in, or is it other things like CryptoKitties?
Well, I think we don't look at those things exclusively. Like I said, I think investors should be diversifying, into protocols and into such applications and other types of applications as well. But I think that diversification is really important because it's really hard to predict like what area of the space is going to kind of be adopted first. Yep. I happen to think that consumer proximate applications are more likely to be adopted first, but it's quite possible that some large institution adopts an exchange protocol at some point. And, how can we really know? So the answer to me is that you have to diversify, and you diversify across the functionality stack.
Yeah, that makes sense. So I guess could you bucket for me what you see as those different diversification dimensions?
Yeah, I mean, like for me, it's kind of thesis driven. So I have, I'm a huge fan of decentralized social media. I think decentralized social media will provide models for media that are much more equitable and efficient and unbiased than what we have in the big centralized companies today. Another thesis is around decentralized exchange. I think it's now clear that tokens have proliferated and they're kind of here to stay, and so you need infrastructure for people to be able to get liquidity in those tokens and to exchange them among one another. And then another interesting theme is like applications that we really haven't seen before in the form that they are, like prediction markets, like Augur, a few other things. And another huge area is that blockchain is great at disrupting various kinds of marketplaces, right? So this is anything from Amazon-style buyer-seller markets to Craigslist to ride sharing to food delivery, and there's just a multitude of different categories that are focused on the marketplace use case using blockchain technology as well.
Got it. Yeah. So yeah, yours is kind of thesis-driven, and I guess would you also include in those a lot of those were kind of maybe what I would argue a little bit further up the stack. In addition to those, there's also just like investing in protocols like Ethereum or deeper level protocols like Ethereum, Dfinity, Tezos, etc. Would that be another bucket that you have?
Yeah. So if you want to go a little bit lower the stack, then things like stablecoins, I think are sort of like lower infrastructure projects. I think that's going to be super important because projects today tend to conflate their platform's transaction currency with their platform's kind of digital equity, right? And so that's where you have sort of the generic transaction token along with its counter argument that when it has a very high velocity, if it's only being used to reallocate resources in that system, and it has that high velocity, its price is likely to go to zero.
Yeah.
Well, that's because there's a very poor separation between the transactional side there and the side that kind of the token that kind of earns a little bit of the cut of the platform. And when systems separate those two, I think it's going to be very interesting. And what I see is a bunch of platforms that have one transactional stablecoin like Maker's DAI, for example, and then another almost crypto equity that entitles investors to some of those returns. So that's another example of a lower one. And then great point. Underpinning all of these things are smart contract platforms like Ethereum. I think there's going to be in 2018 a huge race to try various scalability approaches, and whether that comes in the form of state channels, whether that comes in the form of new networks with different consensus algorithms. It might come in the form of Casper. It might come in the form of Plasma, and many, many different other approaches that people are working on. And I think it's important to be diversified across different networks that provide kind of platforms where smart contract tech is built.
Yeah, that makes sense, and it's good to diversify across the different kind of scalability approaches, whether they're state channels or new platforms entirely, new consensus algorithms, what have you. So I guess kind of maybe transitioning away from this a bit, something that's been hot on people's minds recently is the question of decentralized governance. How are you and how's CoinFund thinking about decentralized governance of the platforms up and down the stack here?
Yeah, I mean, I think we as a space have finally recognized after a few years that governance of decentralized open public networks is kind of like one of the core issues, and also a very, very difficult issue to wrap your mind around. We see that starting, very actively. I think some of the early guys were like, Joel Dietz and Arthur Brightman working on Tezos, like pre-DAO, right? And those were some of the few guys that are thinking about governance. And then really when the DAO hack happened and the subsequent Ethereum fork, that really brought governance into sort of the spotlight. And now you see many, many examples of platforms that are working on governance. You have Tezos and Dfinity are platforms that have protocol level governance systems built in. You have projects like Aragon, which are just totally dedicated to decentralized governance systems, and then many other ones. So I happen to think that we're definitely going to be able to get to fairly straightforward implementations of these systems, but to make them work really well is going to be a huge challenge. Now, in fact, there's something like 200 years of academic research on, it's called the theory of social choice, theory of voting. It has some very, very interesting mathematical results around how do you design governance systems that accurately and fairly and equitably take into account all of the preferences of the voters and then reflect them in sort of the overall preference of the society. And it turns out to be a really hard problem with a lot of trade-offs between, fairness and, the ability of the system to be consistent. So I encourage anyone who's working on governance to check out some of the resources on that. I've tweeted about it and happy to send some references as well.
Yeah, I'll link them in the podcast notes. And the funny thing with that is, my freshman year of college, I took a class called Mathematics of Democracy, which was all about voting theory and those kind of things. And I loved it, but it is actually applicable to my life these days, which is kind of nice. And like you're saying, there are a bunch of kind of interesting mathematical proofs that you can show about the trade-offs that exist within governance, that we will start to get closer and closer to those mathematical proofs as we move from kind of wet, kind of real-life governance towards more kind of smart contracty style governance. So we'll definitely see those implemented over time.
Yeah, I wanted to just call out like a really quick result there because I think it's just fascinating.
Yeah.
There's something called Arrow's theorem,
Yep.
which basically says, like, how does governance work? governance is a kind of study of the set of these things called social choice functions. And social choice functions are just the way that you take like all of your voters' preferences and how do you like compute them to get like a single preference for the society. And so the whole theory revolves around the study of these like social choice functions. The first thing that mathematicians do when they have a large class of functions is they say, let's put some reasonable restrictions on this set so we can reason about the functions kind of within our subset. And it turns out, so Arrow's theorem says that when you impose two very reasonable sounding assumptions onto your set of these functions, then your system collapses into a dictatorship.
Yes.
Meaning there's going to be like one person whose preferences are going to be imposed on everybody else, and you can show that mathematically, which is kind of crazy.
Yeah, I love that theorem, and I think in the two reasonable ones are like, hey, wouldn't you want it to be? It's things where like if you're talking with someone at a dinner party, you're like, wouldn't you want it to be true that if someone voted this way and they changed their vote, that it could affect the outcome or something like that, And it was like, oh yeah, it seems reasonable. And then you say two of those things, and then you're like, oh, that's a dictatorship. And it's like, no.
Yeah.
How do we get there?
Exactly. So it's a fascinating topic, and I think like blockchain folks, in this area and in other areas, I think they also sometimes need to go back and see some of the classical literature on this stuff because it's very useful.
Yes, yeah. We should stand on the shoulders of giants. So I guess to kind of conclude here, we talked about the fat protocol thesis and how it's often true, but not always true, and you need to get texture around where value is being accrued. We talked a little bit about the B2C apps and consumer-facing ones, especially CryptoKitties. Buy your CryptoKitties now while they're hot. And then we talked a little bit about governance as well and social choice theory. Is there anything else that's on your top of your mind before we kind of wrap up here?
Well, I think it's going to be a really interesting 2018. We're about to see basically Bitcoin futures on some of the traditional markets. There's been a huge amount of momentum kind of from traditional investors researching and looking at this space. And I think we're going to open 2018 with the notion that crypto assets are really a new asset class now with some serious money from Wall Street and beyond kind of flowing into it. So it's going to be a really interesting year, and I think scalability is going to be one of the core issues here. Just going back to CryptoKitties for a second.
Yeah.
These guys they were over 20% of the total Ethereum transactions just in the last 24 hours or so. Yeah. And what that says to me is that, if they keep growing and kind of going viral, Ethereum might have some issues around scalability. And so these are the kinds of real applications that bring some of the technological challenges to the top. And that's going to be kind of our job next year is to scale the space not only financially but also technologically.
Definitely, and I would say not even like capital is not scarce. It's like we need to scale it. Yeah, technologically, super agree.
Yep.
Cool. Well, Jake, thank you so much for your time and for being on the show.
All right, thank you for having me, Reese. My pleasure, and speak soon.
Yeah, and for those of you who are listening, you can support me on patreon.com/RhysLindmark. That's /RHYSLIND. And I am happy to say that today's show was recorded, so it will be out there for the people. Great. Thanks so much, everybody, and goodbye.